Good Monday afternoon. It is time for the March New Vision Producer Grain Marketing Webinar. And here's what we're going to cover this afternoon. We're going to go back to last Tuesday, March 9th, with the USDA supply and demand updates and what they did, any changes that they made to the tables, and also the world production estimates out of South America, both Brazil and Argentina. Now, some of these things may get a little bit mixed up because I tried to put everything together, but we're not going to follow the agenda exactly as listed on here because we're going to be jumping around a little bit between corn and soybeans. We're going to take a look at the corn and soybean export, current status and outlook, both on the export sales side and export inspections. Keep in mind now, the export inspections come out each Monday morning. Export sales come out each Thursday morning. We want to take a look and see once how we're doing there. Also, just a quick look at the US ethanol industry. Where are we at today? What have we been through the last few months, over the last year really, with COVID? And what is the outlook as we go forward here? Soy crush industry, a big topic of concern with some folks this year as they are concerned about the supply of soybeans, soybean oil in some cases for a lot of the needs on the users end there. And we're going to take a look at that. Just this morning at 11 o'clock, we had the February NOPA report released. So we'll look at those numbers and see once where we're there as far as current status and outlook also. Take just a quick look at what the market is starting to talk about and think about as far as March 31st. That's going to be the next big report day where we'll have the planning intentions for the 2021 acreage and also the quarterly grain stocks reports as of March 1st. Both have major impacts potentially to prices as we go forward here. China, they've been doing a lot of buying. US corn, US soybeans, US sorghum, US wheat, US pork, a lot of stuff on the books, a lot of stuff being shipped. But there's a question now floating around in the marketplace as far as the demand as they go forward here. If you look at the Chinese line from the government people, they're back to 90% of pre-ASF or African swine fever and everything's fine. You talk to people on the ground in China that are working at some of these operations, not quite the case. And that's where some of the concerns have been in the marketplace here lately. You know, are they going to take the beans that they still have on the books? Are they going to take the corn that they have on the books for the US listed as sales right now? We'll take a look at that and try and give you as up-to-date information as we can. 2021 weather. What's the status of our La Nina? We hear a lot of talk about it winding down, but what hints might it be showing us as far as the growing season remaining yet in Brazil and Argentina, and also an early forecast that we'll look at for weather out of the USA as we get into our growing season in 2021. We'll look at corn and soybean price charts, both old crop and new crop, a little bit of discussion possibly on the basis side there, what we see that might be happening as we go into the spring and summer months, and hopefully, you know, you'll catch some grain marketing opportunities as we go through the information. If you have any questions or comments, you know, sure would appreciate those. You can email, phone call, or text message, whatever works best. Okay, let's get into the report that came out last Tuesday, March 9th. On this particular screen here, on your right-hand side, you see the WASDE or USDA numbers from the February report. These were the ending stocks estimate. Remember, the USDA crop year ends on August 31st, and then the new crop year starts on September 1st. Second column in from your left here is the average trade estimate. In other words, what were the traders looking for going into this report? And then finally, on your left-hand column are the numbers that they gave us last Tuesday. You can see the 1.502 ending stock number on corn. The trade was looking for that to drop about 32 million bushel, looking at stronger demand, especially on the export side, and even a little bit of rebound lately on the ethanol side. USDA kind of threw a little bit of disappointment into the corn market, leaving that carryout unchanged at 1.502. We'll look at those tables in a minute here, but that just kind of puts a perspective of where we're at on the corn side. Soybeans ending stock number 120 million on that February 9th report. Trade was looking for that to be about unchanged. Now, they really thought that the crush could possibly be bumped up a little bit, maybe 5 to 10 million bushel. They thought exports could be raised 10 to 20 million bushel. But they really look at this 120 as possibly what USDA is thinking is pipeline stocks. In other words, they may not show us a number lower than that. Now, we can't raise more beans in this crop year, but we could potentially import beans from South America if we had to. So we may not see this number change, even though a lot of the trade believes it's lower than that. So they were expecting 117. USDA also left that number unchanged at 120. A little bit of disappointment to the marketplace on both ending stock projections on both corn and soybeans. Now we're going to jump down to the bottom here because here's your South America crop production estimates. And we're going to go there first because they definitely had an impact on what the USDA gave us for world ending stocks, and that's the middle table here. You can see the February numbers on Argentina corn, 47.5 million metric ton. Trade was expecting that to drop about 500,000 metric ton because it's been extremely dry. Argentina's had parts in a very serious drought. USDA left that corn number in Argentina unchanged at 47.5. That was a disappointment to the marketplace. On the corn side in Brazil, 109 million metric ton was the number in February. Trade was looking for that to drop a little bit. Remember now we've had delayed harvest of soybeans in Brazil. That delays the crop planting for their second corn crop, their safrinha crop, which is the majority of their corn production. So the trade was looking for that to drop because of the late planting dates. USDA left that unchanged at 109. So when we look at the global stocks of corn, 286.5 in February, the trade was looking for that to drop. A lot of that because they were looking for the South American crop to be lower, came in actually unchanged. So the numbers for the world ending stocks came in a little bit higher than expected at 287 million metric ton. Slight increase from other areas of the world also as far as better production outlook as we go forward here. On the soybean side in South America, 48 million metric ton was the Argentine bean estimate in February. Trade was looking for that to drop slightly, not quite as much damage potentially to the soybean crop because they have received timely rains in some areas. USDA did actually take the Argentine soybean crop down 500,000 metric ton to 47.5. But that was offset by the fact that the Brazilian crop projected at 133 million metric ton in February. The trade was also looking for that to be reduced slightly because of the excess moisture that they've had in some areas like northern Mato Grosso, where there's been some definite harm to the crop and possibly some damage and loss there because of too much moisture. But the USDA actually increased that crop to 134 million metric ton. So when we look at the ending stock numbers of soybeans for the world, trade was looking for that to be about unchanged. It went up slightly with the increased production coming out of Brazil. Now let's look at a table here for the supply and demand picture for corn. And this is a different table than what we're used to looking at. It's from R.J. O'Brien. It goes back and gives us a little bit more of a historical perspective if you want to see how this year compares to others. But we're just going to kind of see once how this transitions from this crop year, what the trade is thinking versus the USDA numbers, and then how that transitions into the next crop year. So here are the numbers that the USDA gave us, or basically left unchanged in last Tuesday's report. Here's our ending stock number of 1.502. Remember, the stocks to use number, or ratio that we look at, always very important to the marketplace. If we divide this ending stock number of 1.502 divided by the total usage of 14.625 comes up to 10.3, unchanged from the February estimate. Now, what we have in the column just to the left there, and this is a private estimate from R.J. O'Brien, but I think it's reflective of what the trade is thinking overall. And you notice their ending stock number is 1.3, 200 million less than what the USDA is projecting. And if we look at the differences, where is that coming from? Well, it's pretty much in exports, where RJO pretty comfortable thinking that the export number on corn is going to be closer to 2.8 versus 2.6 is what the USDA is using. Now, they also have a slightly higher feeding number, 50 million bushel, but a slightly lower ethanol number. So basically the difference is exports. And I think if you surveyed a lot of other people in the trade, they too would think this corn export number definitely has the potential to be in that 2.8 to 2.9 billion bushel. If that were to happen, now you take this ending stock number of 13.01 divided by the total demand of 14.831, that gets your stocks to use ratio under 10%, down to about 8.8%. Definitely gives a little more support to the corn market. But right now, today, USDA is basically saying they're not sure if China's going to take all the corn sales that they have on the books, and there's quite a few on there. So we have to wait and see. Some said, this report was a matter of the USDA kicking the can down the road, seeing once where it stops a month from now or 2 months from now. Now, the other thing we want to look at here is this ending stock number for this year on August 31st becomes the beginning number on September 1st for the next crop year that goes from September 1, 2021 to August 31st, 2022. And what we're going to use here for an acreage number is what the USDA gave us in the Ag Forum. That was a virtual conference that they had this year on February 18th and 19th, and they were using planted acres of 92 million for this crop year. A trend line yield of 179.5. You can see that's up about 7.5 bushel per acre than the current crop. So a better crop projected than what we raised this last year. On the demand side, ethanol slightly higher, believing from the USDA side that we're through the worst of COVID, that America is going to be driving more, burning more gasoline, burning more ethanol, creating some new life for that industry. On the feeding side, also a slightly higher number. If COVID is on its downhill side, we hope to see schools reopened, restaurants reopened, increased demand for meat. And exports also projected to be slightly higher than this year by the USDA. So a pretty aggressive demand forecast. Actually, total demand up about 500 million bushel from this year's 14.6 into 15.1. So even with more acres, about 2 million more acres, a better yield, we can see here that the USDA ending stock projection in their Ag Forum basically let that carry out about unchanged from this year, 1.552 or stocks use ratio of 10.3. Now we can look at RJO's number for next year. They actually have a higher corn number on acres, up to 93 million, a slightly lower yield at 178.5, a little bit of differences in demand, but basically around that 1.5, 1.6 billion bushel carryout, stocks use ratio at 10.6. And I think that's pretty reflective of what a lot of people in the trade are thinking right now. Now, what do we have to do to get a better corn market? Going back to that stocks to use ratio, and we can see on this chart put together by StoneX and their group that really we have to get that stocks to use ratio on corn under 9% to get a sharper uprise as far as prices. Now, what about the corn usage? This is an older chart, and I apologize, it isn't real clear, but it kind of gives a nice perspective. And I think some of these numbers are maybe figured a little bit different, but the way I look at this thing, exports this year are going to amount to about 17.8% of our corn usage out of the US. Feeding about 38.6, so very close here. And on the ethanol side, slightly higher, just under 34%. So, even though the focus is all on exports, our two biggest categories of corn usage, really ethanol and feed, look to be pretty stable. And then going on to break this feeding down on corn, here's the by species as far as 27% beef, 28% poultry, 24% swine, 19% dairy. Actually a pretty good split as far as who actually eats that corn and uses that corn in their rations. Okay, let's talk a little bit about export sales and inspections. And we'll do this both on corn and soybeans, and then we'll have a couple slides to kind of wrap it up when we get to that point. Up on top here, we have the weekly corn export sales through week 26. Now, this was put together by Arlen at StoneX, and it's actually a week outdated. Since the report, we had week 27 last Thursday on the 11th. That's not included on this chart, but really they haven't changed a whole lot. At that point in time, sales were projected to be about 460 million above the pace we need to be at, above that 2.6 billion bushel number the USDA had. But when we look at the shipments, remember the sales come out each Thursday. This is on the books, but hasn't been shipped yet. Export inspections come out each Monday morning. And if we look at how we've been so far this year on this green line here, we can see that we started out really behind this blue line is where we need to be to make the current projection. Now, the last 8 to 10 weeks here, we've been doing much better as we've kind of geared back a little bit on the soybeans to some extent as the market, prepared themselves to get more beans out of South America, out of Brazil. We've seen export space and export pace on corn pick up drastically. Now, today's number was another record type number, we'll look at that. Over 80 million bushel of corn inspected last week and reported in today's report. So even though on week 26, we were about 20 million behind the seasonal pace on the inspection side, we're going to look at the up-to-date numbers and see that we're better off than where we were here a week ago when these numbers were released. Now, here's a chart put together by the University of Purdue. They had a webinar after the report, and I borrowed a couple of slides from them. This looks at corn exports this year. Here's 2020 right here. And the blue are total corn exports through the end of February. So basically, it goes from the start of our crop year, September 1st, through the 4th week of February. And we can see, corn exports doing very well. Up 82% versus a year ago, 2019. We were still trying to kind of work our way out of the trade war with China and a lot of other things going on in the world. But the interesting thing here, total corn exports up 82%. And look at the amount here in the red bar. This is China, 278 million bushel of corn out of the US taken by the end of February. If we look at previous years, we just don't even see them up there. So that's something that definitely has been a nice shot in the arm as the US market goes forward here on corn. Now, how are we doing, competitive wise, and what does that mean possibly for the outlook? And that's what we're trying to get a handle on here. And when we see on this chart, and this comes out about each Monday. So if we look at how we compare, here's the main corn exporters of the world. In other words, if you're a buyer of corn globally, this is where you're going to go to look for the corn. The US is the #1 exporter of corn in the world. Argentina and Ukraine are two of our bigger competitors. So how are we competing right now? Here's the price per metric ton for April, May, June, July. And you can see right now we're very competitive against the Ukraine because they've even put some stops in as far as the amount of corn and wheat they can export because they're worried about controlling the price of food within their country. But when it comes to Argentina, we're about $10 to $13 a ton overpriced. So as we go forward here, if the buyer feels like he can get execution out of Argentina, definitely cheaper corn out of Argentina than out of the US as we go forward here. So it's very important that we execute the sales that are on the books, because right now, if you're a buyer out there, it's going to be tougher to get that new business put on out of the US. Before we go into soybeans and talk a little bit more about exports, let's take a look at the ethanol side. Here's another chart from the University of Purdue. I really like this thing because it goes back through the whole COVID period. And what this shows is the ethanol production by week, and it compares it to the previous year. So in other words, if we go back here to last February and March, we can see ethanol production down 40 to 48% versus the previous year. What's going on here? Well, remember mid-March is when COVID really started breaking, and there were a lot of ethanol plants slowing down, shutting down, not so much that they couldn't find corn to process, they didn't have anywhere to go with the ethanol, and the whole country as a whole shut down or came very close to shutting down because of that early outbreak of COVID. As we went through 2020, production gradually improved as people became more comfortable and we got used to our social distancing and everything. But really for the year, probably averaged a good 10% below the previous year. And then we were cruising along here about right in that range, kind of where people were expecting it. All of a sudden here a couple of weeks ago, we have this big drop off. Here's that temperature spike where we had, below normal temperatures all the way down into Texas. In fact, below zero temperatures into Kansas and Oklahoma. Definitely a situation where ethanol plants either couldn't get the natural gas that they needed to operate, or they chose to merchandise their natural gas and slow their plants down. Now we've bounced back after that, and hopefully this is a sign that we're kind of over the hump as we go forward here. Now the encouraging thing, and this is also a slide from the Purdue University, that shows margins. And actually, a lot of people have thought, with COVID and a lack of driving, poor ethanol demand and all of that stuff, that things were going to be really tough for this industry. But we can see that actually, for the most part, margins were not all that bad during the past year. There were some outbreaks. Here's when COVID really started setting in. But, overall, as things went back to normal, things were adjusted and margins have been okay. And they're okay right now. Ethanol plants are still going to run. They're not making a huge amount of money, but they're profitable enough to be able to keep grinding that corn. And we need that because once again, going back to look there, that's a little over a third of our usage on corn. Now here's a what if slide or a little bit of history here. And we're not going to spend a lot of time, but we'll look at the same information on corn. Remember on March 31st, one of those key reports will be the stocks in all positions. This looks at the March 1 corn stocks number, USDA number compared to the average trade estimate. If the two I agreed 100%, you'd be right on this zero line. So where you see the green bars, that would be a case where the USDA corn stock number comes in higher in that March report than what the trade was expecting. And I think maybe that's why the trade's a little bit nervous as we go into this report, because if you look at 4 of the last 5 years, we've had the USDA finding more corn than what the trade thought was going to be out there. Now last year, different story. In fact, the USDA number was much lower than what the trade was expecting. And of course, the market responds to that. This year, with carryout projections the way they are at that 1.5 number, if we were to find a situation where the corn stocks number is lower than expected in that March report, it could be very dynamic. We have to wait and see, but it's getting closer, only a couple weeks away now. Here's our supply and demand table on corn. Same thing, we're going to take this particular chart a little bit more of a perspective. And here's our USDA numbers from last Tuesday on March 9th. Remember, they pretty much left everything unchanged. They did a little bit of jockeying around with residual, but overall, you know, things were unchanged, 120 million bushel carryout. If we divide the 120 by the total demand of 4.575, we come out with a stocks to use ratio of 2.6%. The tightest stocks to use ratio on soybeans we've had in history in the US. And other years when we were that tight, going back to 2013-14, ending stocks at 92 million, we know that's definitely an environment for beans in the teens. So how does the trade compare to this? Here's our RJO's number, and we don't see a lot of difference. They're projecting around 116, basically thinking that this is pretty much pipeline stocks to use ratio of 2.5%. A few differences in the numbers. They have a little bit different number on residual. They have a higher export number by 10 million, a higher crush number by 10 million. And I think a lot of the trade would feel that way too, but they also have a higher import number. Remember, we really can't raise any more beans in the US until then, but we can import beans. And more people are talking about the fact that we may see this bean import number increased by the USDA as we go forward, or we may see companies actually importing soybean meal out of South America rather than pay high basis levels to originate beans to crush in this country. Water under the bridge to come. We don't know what's going to happen, but something to be aware of as we go forward. Don't think only on that supply number. Think that that supply can be adjusted by imports because South America will have another big crop this year. Now, once again, this 120 million ending stock number for August 31st becomes our beginning number for next year. And we'll look at the acres number from the Ag Forum in February. 90 million acres, so an increase of close to 7 million acres of soybeans this year. Beans work all over the country. If you look at the economics there, they're a better advantage to corn, to sorghum, to cotton in a lot of areas. But of course, it'll depend on what the farmer decides to do. Spring weather may have a bearing on that also. But in the Ag Forum, USDA had 90 million acres of beans, projecting yields about 0.6 of a bushel higher than this year. So more acres, bigger yield. And when we look at demand, we see crush basically unchanged from this year. Exports actually a little bit lower because of the bigger crop in Brazil and questions about Chinese demand. But look at this. The ending stock number doesn't grow all that much, even with 7 million more acres of soybeans. Ending stocks projected for next year at the Ag Forum, 146 million. Stocks to use ratio of 3.2%. That is still very tight. Not as tight as this year, but still an opportunity for fireworks as we get into the next crop year. When we look at RJO's estimate of on the private side, maybe, acres also at 90 million. They have a slightly better soybean yield, a little bit differences on demand. Their ending stock number around 135. So you can see this is where you hear a lot of talk about we're not going to be able to solve or fix this bean situation as quickly as what we might like to, because stocks potentially stay tight into the next crop year. When we look at the stocks to use ratio on soybeans, just a reminder that once that gets to be under 7%, we see a rapid increase to try and ration that demand or make soybeans last. And with that 2.6 stocks to use ratio right now, still a very touch and go environment for the bean complex. Now, we don't have total use here. If we looked at total use of soybeans, about 49% of the soybeans that we raise in the US go to export, about 48% go into the crush. So this is looking at more of where do the products go that we're crushing for soybeans. And of course, the soybean meal, pretty much all in animal feed. But the interesting one, and the reason I wanted to include this slide, was on the soy oil side. You know, about a fourth of the soybean oil that we produce right now goes to biodiesel. But look at this side that goes into food. And that's something you're hearing a lot of talk of right now. The fact that some of these companies, food companies that want to guarantee or maintain their supply of soybean oil as we go through the balance of this year, getting some reports from crushing industries and stuff that things are definitely going to be more expensive and maybe tougher to source. So if you want to lock in your soybean oil, here's the price, much higher than normal, just extravagant basis levels on some cases being quoted, where nearby soybean oil basis might be 150 over. If you wanted to lock in May, it's 300 over. If you wanted to do June, it's 400 over. Now, what does that mean, and why are we talking about that? Folks, that's a concern that we have as far as higher input costs for food means possible increased cost of food and possible inflation. We'll talk a little bit more about that later. Here's the same information on exports, our sales on top, and you can see sales have been very, very strong this year. Export sales come out on Thursday. As of the week 26, about 234 million above the pace needed. Now, we all know that as we get farther into this year and into March and April and May, more and more soybeans become available out of Brazil as they get their crop harvested and moved to the ports. This is going to tail off, and we could see some cancellations or rolling into the next crop year. What about the shipment side? Remember, we were running a little bit behind on shipments on the corn side. Not the case with beans. In fact, you can see the current crop year here. We've been above the seasonal pace we need to be at just about every single week. In fact, if we don't slow this down real quickly, we're over 300 million bushel ahead of the seasonal pace on soybeans. We have to put the brakes on here because we have an ending stock number projected at 120 million. We can't ship this many soybeans. We have to ration demand. So it shouldn't be a surprise that we start seeing these numbers on the inspection side of soybeans come down fairly drastically. Now here's a slide also from the University of Purdue that talks about the soybean exports this year versus a year ago, and also how many of those went to China. We can see that 2020 versus 2019, soybean exports up 78%, and 98% of that increase is in the red here, meaning to China. You see, there's a lot of sales on the books for corn that China has yet to pull, but on the soybean side, they've been doing a very good job about staying pretty current. In fact, more current than when they have in times past, as far as pulling their sales that they actually make with the US. So those beans are gone, never to come back. Now, what about sales as we go forward? Here's the outlook side of soybeans. And if you're a buyer of soybeans in the world, you're going to look at the following countries. You're going to look at the US, Brazil, and Argentina. Now, Argentina, as a rule, doesn't export many whole beans. They crush the beans and export the meal and oil into the world. In fact, they control right around 40 to 45% of those product markets. But on the whole soybean side, the competition is usually between the US and Brazil. Now, if we looked at this a month ago, excuse me, and 2 months ago, we've seen the US very competitive. In fact, in a lot of cases, the US was cheaper. Why? Because Brazil didn't have their new crop beans in position yet. And the delayed harvest allowed the US to stay competitive longer, especially when China wanted the beans quick ship to get the product over there so that it could be crushed into oil and meal, livestock feed for their building hog herd that they were trying to, recover from after ASF. But now we see, based on last week's numbers here, 551 a metric ton for beans out of the US, 517 out of South America, out of Brazil. A difference of around $30 a metric ton, plus or minus a few dollars. $30 a metric ton is over 80 cents a bushel. So we should not really expect to see a lot of new sales coming into the US. Brazil has beans being harvested, moving into position at the ports, and they will take that market back. But as I said, we've shipped so many beans already, that doesn't really hurt us all that much. Okay, here is the inspection update from today's report that came out Monday, March 15th. Once again, I'm sorry we're jumping around a little bit here, but I wanted to get this information as current to you as we can. And what we look at here are the weekly inspections on corn. You can see 2 weeks ago, 80 million bushel of corn inspected in that report. Now, when that originally came out, that was listed as 65 million. And then a few days later, the USDA came out with a correction, raising that up to 80.6. This was an all-time record for a weekly export of corn. And look what we did today. Today announced 86.8 million bushel of corn inspected this past week. We are starting to see these exports on corn, the inspections pick up drastically. In fact, remember on that page that we looked at, or slide we looked at a little bit ago, we were running about 20 million behind the pace we needed. Based on these big numbers we've seen the last few weeks now, after today's report, we're actually on pace to be above the 2.6 billion bushel export number by the USDA by around 90 million bushel. If this pace continues with these big numbers, you know, we're going to see this thing grow up. Remember that RJO private estimate projecting around 2.8 billion bushel. So there's still hope that this corn program gets executed. Big question mark is, will China continue to take their sales? What about soybeans? We're definitely seeing a slowdown. If we look at, 5 weeks ago, 70 to 80 million bushel a week being inspected, and now we're down to a 10-week average of about 19. Excuse me, that was today's today. Current 10-week average is 56, but definitely coming down as more crop becomes available out of Brazil. But 19 million bushel of soybeans to be loaded out of the US on this week, the week of March 11th, that's a big number. That's much higher than what it should be. I think it reinforces the fact that, number one, China needs the beans now. And it also reinforces the fact that significant delays in harvest at Brazil brought more, export business back to the US. Now, we also have to keep in mind that maybe they didn't get the beans in position to ship early in Brazil, but the beans are still there. So this could have a longer tail. And even though it looks very friendly to the bean export program out of the US right now, could be a long tail that kind of haunts us because all of a sudden they have beans later into this crop year to compete against us. But we're well over 87%. In fact, I've seen estimates if you bring in the inspection number or the beans that are exported that are not inspected, that number's actually been running higher than some of these weekly inspections. You're right at 90% of this USDA export number on beans, 2.25, 90% has already been shipped and gone. So we have to really put the brakes on this export side, or this number on the USDA side on bean exports, 2.25, will have to go higher in future reports. Now, does that make the ending stock number come under 120, or does that make the USDA bring imports into the picture? That's something that we'll have to watch in future reports. Now, on the export sales side, these are the reports that come out each Thursday. These are, contracts that are on the books, but haven't been shipped yet. And of course, they can be canceled. They can be rolled into the next crop year, or they can be executed. This chart comes from John Stewart and Associates. And here's our USDA number currently at 2.6 billion. Through last Thursday's export sales report, 90% of this projection has been sold and put on the books. On the soybeans, and we went on just compare that. Here's the 3-year average and the 5-year average of where we normally are this point of the year. So definitely more corn sales on the books than we're used to seeing at this time of the year. What about soybeans? 98.7% of the USDA number of 2.25 billion already on the books. And as we looked at it those previous slides, a lot of that has already been shipped. That is much higher than where we've been, 81% on the 3-year average, 82% on the 5-year average. Here's our crush information that came out this morning. And I put both charts. I realize they're a little bit small, but what we have on top, these are also from R.G. O'Brien. The gray bars are the monthly record crush amounts of soybeans for each month, starting in September into August of the following year. And these red bars are where for instance, the soy crush came in September, October, November, December, January. First 5 months of this crop year, we made new records of soybeans crush every single month. And here's where we came out today. About 13 million below trade estimates. The trade was looking for that to be around 168 million bushel, 165, came in at 155. So lower than expected, and you can see it a little different perspective. Here's the last 6 years of crop years of soybean crush, and we were doing well above record type levels until this report. Now the excuse in the report said cold temperatures, some of the winter storms that it went through. You know, I don't know if that's a whole thing or not. It almost seems like this could have been a mistake of some sort, but you also see that seasonally, it seems like this February report tends to dip down. Now, the million-dollar question as we go forward here, will the industry on the soybean crushing side find the beans to be able to source and crush as we go forward here? Right now, you know, I think people are comfortable we can make the USDA crush projection because we were so much above where we needed to be early in the crop year that if we end up being below for a few months here, still probably going to be all right with that crush number of around 2.2 billion. Here's our soybean stocks historical perspective. And I think that the trade is also looking at this thinking, you know, we don't have to worry so much today because if we look at this, the last 4 consecutive years, the USDA soybean stock number has come in higher than what the trade was thinking. Remember, if the two numbers agreed, they'd be right on this zero line. So anything gray were surprises where the soybean stocks were lower than expected, the green numbers higher than expected. You can see recently, if you go back to the last 10 years, definitely a pretty different, you know, paradigm being shown here, where they tend to find more beans in this March 1 stocks report versus years ago where we were always coming up short. I don't know if they changed their formulation methods, but once again, this is something we have to watch very closely on that March 31st report, because if we find that the bean stocks are lower than expected, like in 2016 with 120 million bushel carryout, that could really be a dynamic in the soybean market, would really force the rationing process to increase dramatically. Okay, let's go globally a little bit and take a quick look here at China. First of all, I want to point out, and this is an interesting chart, I think, shows weekly hog prices converted to US dollars. Good pork prices for the American farmer in this particular report, as of the 11th, average of around $88 a hundredweight. And looking at China, you can see why, you know, number one food item in China, pork, $209 at the same equivalent for US versus US. So, you know, it does work, and very important for China to be able to produce pork because it is a preferred meat of their people. Now, if we look at a series of charts, just to kind of try and get a flavor on where they're at. Here's Chinese hog production in the blue and their hog stocks in the orange. And we can definitely see when ASF, or the African swine fever, started to have an impact there. We've seen hog numbers or stocks go down and also production go down. Well, they came to the world to import, and on the light gray lines here were the pork imports by China in 2019, the darker lines 2020. A lot of imported pork going in because they needed to have that staple item for their people because that's a preferred meat. Where did they get that pork? Well, a lot of it came from the European Union, but a high percentage came from the US. Good for the American farmer, good for soybean meal demand and corn demand in the US as we finish those hogs. Now, one of the questions that are being asked by a lot of people, on these gray bars in this chart here, we see the number of sows that China was reporting from their government numbers in 2020. And then the blue line is 2021 for January. You can see, according to this, their hog herd is, number of sows are getting very close to where they need to be. But if you talk to people who have contacts on the ground, estimates that they've lost 6 to 8 million head of sows recently due to various diseases. And we've seen a higher than normal disease situation even in hogs in the U.S. this year, with as far as farrowing results and number of pigs. And because of that, there's a fair amount of barns sitting empty even in this country. What about feeding hogs in China right now? Well, here we look at the price of corn, and current prices in 2021 still running around $11 a bushel US equivalent. We can see that's much higher than the pre-ASF days and much higher than 2020. Crush margins are still very good, stronger than normal. These would be the soybean crush margins, but some of this would be because they purchased soybeans earlier before the market rallied. As you can see, that crush margin is coming down as they get into their more expensive beans. We see soybean meal futures at the Dalian exchange also much higher. So their inputs of corn and meal are high, but when you look at the feeding margins, here's the pre-ASF days, they're still making good money finishing hogs, making that pork in China. Now, the question about demand as we go forward. Now, according to the Chinese government, they're back to 90% of capacity, even though a lot of people on the ground say they don't think it's quite that good. But it has a big impact on potential demand, because if we look at here, we can see in the import side, these are the lighter gray lines. As they encompassed more and more of the ASF in China, imports slipped down to almost 80 million metric ton, then started rebounding as they started building the herd back up. Currently projected by our USDA at 100 million metric ton for this crop year. And then a lot of estimates have that going up 103, 105, even higher in the coming year. But that's based on the fact that their hog herd is back to being 100%. If they've really lost 6 million head of sows and they're having issues with different types of disease and even some ASF popping up in some of the areas of China, what about the demand? And this is looking at soybean demand, but it also could have an effect on corn demand. What we do know about China, and they've been very open about this, is that as they made the transition from pre-ASF to post-ASF, they pretty much made it a law that people aren't allowed to feed table scraps or garbage to their hogs. At one time, I think almost 60% of the hogs raised in China were raised on small family farms. They fed them table scraps, they fed them, meat that wasn't eaten, and they think that's the way ASF was really perpetuated. So right now you can't do that. And what China has done is went to a Western type ration. And that means more corn, more soybean meal. It basically means rations like we feed in the US. And that is moving the hog production off of the small farms into these mega facilities. I think in our last webinar, we looked at one being built, 28,000 sows on one farm or production facility in China. The other thing that I'm experiencing as I see these diets transitioning is products that we use for our starter feeds for small pigs. The whey and the whey permeates have more than doubled in price over the last couple of months here as China has come in and upgraded their rations. They're now using that in their starter feeds and caused a really demand vacuum as far as the available supply in the world, and those products are very expensive right now. Okay, let's talk a little bit about weather. And here's Argentina's crop condition ratings. This is actually a week older, the charts. So we see here the good to excellent rating on Argentina corn at 25%. Since then, the revised report that came out over the weekend has that dropping 8% down to only 17% good to excellent. And look at how that compares to last year at 50%, the year prior at 62%. Definite drought damage to the Argentina corn crop. And we did not see the USDA lower their production number on corn in this last report. Does that happen as we get into the April report so forward? I think a lot of the trade believes that will happen. Remember, Argentina is a competitor of the US when it comes to corn exports. So could this possibly bring a little more business back to the US? What about soybeans? In this report, 10% rated good to excellent. updated numbers over the weekend. This good to excellent rating on soybeans in Argentina dropped another 4% down to 6%. Last year, 50% good to excellent at this date and time. The year before, 52%. Definitely looks like there's crop damage to that Argentina crop. Here's soybean harvest out of Brazil. Now, this was the previous chart of 34%. I've seen numbers now that they expect this week's report to get closer to 50, maybe slightly higher. But you can see if we look at the last several years here, it's still behind normal. Now, they're going to have a bigger crop potentially than a year ago. Last year's crop was revised to around 128 million metric ton. USDA is at 134 right now. And I'd say that's a pretty good figure as far as what the rest of the trade is thinking. I've seen some estimates as high as 138. I've seen estimates as low as 132, but definitely a delay there. And as the soybean crop harvest is delayed, this is just looking at one state, Mato Grosso, which is one of the larger states. In fact, Mato Grosso, I think, is as a state, is bigger than our state of Texas. So it's a big area, one of the prime production areas. And what this looks at is the planting pace. And you can see they're about 70%, between 70 and 80% planted. But keep in mind, this is as of about the 8th of March. And this would be compared, you know, I'd use an analogy like if we plant corn in our area after June 1st, we know we're going to sacrifice yields. It's just a given. That magic date in Mato Grosso would be closer to February 15th. So they're planting a lot of this corn. 20 to 30% of this corn is going in the ground in a time frame where it's 2 to 3 weeks late. In Mato Grosso, that's a big thing because if we and the reason why, if we look at their precipitation pattern, you know, as far as when their rainy season comes, you see they usually have adequate moisture in February and early March, and that's when they want to get that corn seed in the ground so it has moisture to get a good start and get done quickly before they run into the summer heat, which can affect pollination. Because you can see that precip history, if we look at the 15-year highs and lows, definitely trends sharply lower. And by the time we get to May and June, they don't get a lot of moisture and they still have those high temperatures. So a lot of people really think that this corn number in Brazil also has a potential to come down. In this report, in last week's report, the USDA did not lower that. So potential for both corn crops in Brazil and Argentina to come a little bit lower. We also see strong demand for domestic corn in Brazil due to an expanding ethanol industry and also the livestock industry that wants to be more proactive and have meat available for export to China. So could be interesting. And another reason why if we see the sales continue and the shipments continue on US corn, potentially more expansion as we go down the road. Let's talk a little bit about weather. Here's our updated La Nina map from about a week or so ago. And remember, the La Nina is cooler than normal sea surface temperatures along the equator. That would be right along this line right here. But you can see a lot of those waters right off the coast of South America now have definitely warmed. Not as blue. If we looked at this a month ago and 2 months ago, much darker colors right up along the coast. So the La Nina tends to be drifting farther out into the ocean and causing less effects. Most people would say they think it's kind of a dying La Nina. It may not transition all the way, but probably not do quite the damage weather-wise to South America as we've seen here recently. Now, another area to watch, more crucial probably for US weather, is this sea surface temperature off the coast of California. And you can see right now it's blue. This has cooled pretty dramatically over the last few weeks here. If we're going to have drought type conditions in the Midwest during the growing season, this is what we need to watch. If it's cooler than normal, we increase the risk of drought type conditions in our growing season during June, July, and August. Now, if it stays warm, or if this warm water moves up along the coast, then it usually creates a situation where we have timely rains, the fronts go through. So this is the area that really needs to be watched. And if you remember here, some of you at a previous meetings that we've had a few years ago, we talked about a gentleman that works at a university down south that referred to the phenomenon out here called the blob. you know, and you can see right now this area that he calls the blob, or I think it was region 3 in his analysis, definitely looking at warm waters right now. So I listened to a webinar of his here a week or so ago, and he's really not talking about the potential for a lot of crop production problems in the US this year. He thinks this sea surface temperature out here is going to stay on the warmer side, but he also cautions that if this were to happen, definitely could create some challenges as we go through our growing season. Here's our drought monitor from last week. Now, of course, this looks pretty ominous. I think well over 60% of the US in some type of drought, but we can hear all of the reports that have happened this weekend. 2 to 4 foot of snow in Colorado, you know, good moisture over a lot of the wheat areas here that were extremely dry. Although I was reading something from World Weather this noon here saying that some of those areas, the rains were actually disappointing. And even up here, yeah, we had a nice little batch of snow. Hearing a lot of talk of 6 to 8 inches, but that's about a ½ inch to a possibly 3/4 of an inch of moisture. Probably not a drought buster. It sure makes people feel better, but the risk still is maintained. I think that we have some challenges as we go forward here. Now, here's a what if scenario, not a prediction, but just to give you something to think about. What we have on top here, this is a weather model that looks at temperature possibilities for March through May of this year and precip over on your right-hand side. We can see in this particular model, the blue is below normal, the white is normal, and a lot of the heat stays way to the south, probably something that Texas would like to have now, especially after the cold snap that they had earlier. But pretty much normal to below normal on temperatures for this time frame. And on the precip side, pretty much normal for our area. You can see the dryness stays in the area that's really been impacted by the drought monitor. But look at this area of above normal precip. Covers a good part of the eastern corn belt. Those folks are going to want to get corn planted early. And if they in fact have above normal precip, maybe that gives this market a little bit of concern, even with more acres being intended to be planted. We'll have to wait and see what those numbers are as we get to that March 31st report. Now on the bottom, they flip-flop screens. So actually, here you have temperatures March through May. This is the temperature forecast June, July, August, and your precip for that same period over here. Now, they did caution, and this slide came from Arlen at StoneX, it did caution that this particular model tends to over-exaggerate heat. But you can see their early prediction for that summer period, basically above normal temperatures for the entire United States. And when you look at the precip side, the green areas would be above normal, the white areas normal, and the brown, the tan areas below normal. If this were to verify as we get closer, you can see probably some definite volatility and challenges because some of these areas that are predicted to be below to much below are areas that are a little bit short of moisture right now, including our area here. Okay, before we get into prices, just a little bit of humor to kind of break things, but something that a lot of people in the industry are concerned about. Our Fed chairman and everybody in Washington says, don't worry about inflation. We'd love to have a little bit of inflation. Well, you know, we've seen some inflation in ingredient prices for our feed mills. I think you farmers have seen your ingredient prices go up. Look at the price of fertilizer last fall versus now. And, you know, they can call it what they want to call it, but you've got some inflation going on in a lot of these markets right now. But right now, the attitude of the Fed is relax, it's extinct. You know, and we don't have to worry about inflation. In fact, we'd love to have 2% inflation. Question is from the marketplace, though, is what if it becomes more than that? And here's something a lot of people in the marketplace kind of look at as a long-term thing. This is a 10-year US Treasury yield. And, you know, and it was trading back in 2018, 2.5. It's been in a trend line down. You know, to March of 2020, we were down to 0.5%. You know, you basically almost had to pay banks to have money on deposit. But you can see what's happened here in the last couple of months. You know, and even though we're relatively low from a historical perspective, this market has traded up as high as like 1.6 to 1.65%. That's a move of over 100 basis points in just a couple of months' time. That's significant. Definitely a sign that some people are a little bit concerned that we have to watch this inflation thing a little bit closer. And this chart came out from the FAO at the UN, showing that global food prices now will have risen for 9 consecutive months. So as we come out of COVID, if the world has more demand, and we all know that inventories to a large degree have been probably a little bit tighter than normal. In the US, another round of COVID relief money coming out into a market that has possibly limited supplies or inventories, definitely not excess inventories. Is that a recipe for inflation? Time will only tell. Harlan's formula as far as prices, as we get into prices, price is the function of supply and demand, but it's overridden by the function of money. We're going to start out with the change that went into effect today at the CME, or Chicago Board of Trade, where position limits in the spot month were basically doubled in a lot of commodities, on corn, on soybeans, soybean meal. Now, what does this mean? It means our managed money crowd, our commodity funds, can hold bigger positions than what they have in the past. But that can be both from a long side and from a short side. What does it mean? Well, we don't know. We'll have to wait and see. But in the eyes of a lot of people in the marketplace, this is a recipe for much increased volatility. In other words, a potential for higher highs and lower lows. Time will tell, but we've kind of taken the cuffs off a little bit, and they're allowed to have much larger positions than what they've had in the past. Here's where they were going home last Friday, long about 330,000 contracts of corn. Keep in mind, last August, they were short almost 200,000, but they've been long for quite a while here, especially the last 30 days. Soybeans, long about 131,000 contracts, down a little bit from where they were in February, but still higher than what they were last year or last August, before we kind of got this thing excited with some of the changes. Here's our price chart through last Friday, and you can see this corn market on the nearby basis has pretty much been in a sideways pattern, waiting to see once, are these exports going to get executed? What are the corn stocks going to be? Potentially we break out of this sideways pattern as we get to the month-end reports here, the grain stocks and acres. Today, and I think a lot of this probably had to do with that outstanding corn inspection number, 86 million, nearby May corn futures in Chicago, up 10.5 at 549. So, we're at a good price level again right now. We have to watch this thing closely, I guess, as we go forward. Previous contract highs on the nearby contract at 574. From a monthly chart, here's our contract highs at 574. You can also see that, really the major area of support now is way down here around this 450 to 460 area, where we see that long-term support resistance. Definitely a swing point. The way it looks right now, we don't go back to test that area. And if you believe the numbers for next crop year, carryout could be very similar. We could be in the similar type dynamics. Now, if some of this demand starts to slip away, if the USDA is right and that corn inspection number, corn export number is only 2.6 billion, then maybe things change as we go forward here. But definitely opportunities. What about nearby soybeans? Today we closed at 14.19, up about 6 cents. Contract highs at 14.53. So, we've got kind of a respected trend line here that the market bounced off of today. If we were to take that out, you can see some of the support levels here. Definitely good support under the market. We've shipped a lot of the beans already. As we go forward here, potential challenges, as we ration out this demand to finish the crop year. On monthly soybeans, definitely 14.53, our previous highs. Can we go higher? Yes, we can. We've done that in other years where we had to ration at a faster pace. A lot of this will depend on how quick do we tap the brakes. What does that bean stocks number say at the end of the month here? And then just a thought about new crop acres before we get to the new crop price charts here. Remember, in the USDA Ag Forum, they had projected at 90 million soybean acres, 92 million corn acres. That would be a total of 182 million corn and soybean acres planted. That would be an all-time record. Previous history shows that we've only planted a total of 181 million. That's our previous record. Now, I looked at another set of numbers here this morning that totaled 183 million. Somebody may ask, where they coming up with all these acres? Well, last year we planted about 173 for a total on corn and beans, but there were like 9 million plus prevented plant acres last year. You know, to get to these type of numbers by the USDA or by the private, 182, 183 million, we have to get all of the prevented planted acres planted that were missed last year and possibly bring some acres in from other areas. Now, we're also going to have a strong pull for acres on the sorghum side, especially you're in some of the southern states where moisture concerns still exist, even after this snow and rain event. You know, sorghum can withstand a little more droughty conditions. So China has bought a lot of US sorghum. Sorghum prices for old crop were good. Sorghum prices for new crop are good because China wants to buy new crop sorghum also. So there's going to be a challenge there. Can we get to the acres? Our first blush at that comes on March 31st, that planting intentions report. So far in March, you notice that the old crop corn charts were pretty much going sideways. Not been the case. You know, with carryouts projected the way they are right now, we've seen new highs on both new crop corn basis of December chart and new crop beans basis of November. In fact, we made new highs on the December corn chart on March 8th, just day before the crop report, 485. How does that compare to a monthly basis? Well, you know, 485, our current high is a 6-year high on December futures. I just would really recommend that you keep a close eye on this, folks, because these are opportunities that we really don't always get. You're going to plant another crop, you're going to harvest another crop, and you can see, can we go higher? Yeah, we can, but we really have to have some serious drought type conditions going on or something really a big surprise. This is much higher than where we've been for the last 6 years. Don't lose track of that. If you think things are going to be all right and you think the weather's going to be good and we're going to plant and raise a good crop this year, get some protection on, because we know that these prices can correct down faster than what they went up. Here's our new crop bean chart. Once again, making new highs ahead of the report on November on the new crop side, 1265. How does that compare on a historical basis on the monthly chart? Well, you know, 1279 might be our next stop, but once again, to go higher on the new crop side, we've really got to see some serious problems. If we throw some weather into the market this summer, could definitely happen. Or if we see this bean stocks number in acres not quite where people think it needs to be, the market will react. Here's a closing cash bid price at page at New Vision from last Friday, March 12th. We always look at this thing and try and figure out, is the market telling us something, or what should we be doing? Nearby corn at 521. Keep in mind that was up about a dime today. So, you know, if you looked at cash price, is going to be higher than that. The market's really pretty flat all the way out into next August. If you have farm stored corn unsold, still all right to sell the carry. There's not a lot of carry there, but it's about 4 cents out into the July, August timeframe. What about new crop on corn? 443 off the combine. If you have farm storage and can dry it at home, sell the carry. That's what the market's telling you to do. 20-cent carry from October out into June of 2022. So definitely something to keep in mind there. And, you know, I don't know if we want to even talk about it, but, you know, look out farther. Keep a close eye on this too, because eventually we will correct these production shortfalls. You're looking at new crop corn off the combine in October of 22, just a little bit below $4. Looks cheap compared to what we have here, but how quick can we respond and rebuild this situation? What about the basis side of corn? If you look at these summer months here, you know, these type of prices, a lot of times we had wide basis levels to work with, but 3.5 to 4.5 under for June, July. Good basis levels out there too. So it's all right to possibly convert some of this to a paper position if that meets your fancy and you feel comfortable from a risk standpoint. What about soybeans? A nice carry, nickel carry for April, May, June, July. Pick your poison there. Good prices. You know, today's market up a little bit higher, so getting close. I think we have touched that $14 area, and you know, there's potential for us to do that again. What about the new crop side? 1174 off the combine. As you can see, the spread is narrowed up where the new crop on both corn and beans have been going up higher than the old crop. What about storing beans off the combine this fall? Well, let's see how that works. 1174 in October. Well, this doesn't look right. 1153 for next June. That's an inverted market. 21 cents a bushel. What's the market telling you? Don't worry about that bin you had that you've already stored beans in. If you need to fill it with something, fill it with corn because you've got some carry to work with there. On the bean side, the market's saying, we want your beans right off the combine. If you decide to store beans, you're going to have to not only pay storage, but you're going to have to pay the market because they're going to try and take some of that money back out of your pocket. Here's some take-home points as far as what Arlen at StoneX thinks things to watch as we go forward here. Soy complex, we've talked about that, 120 million bushel carryout. It remains tight, potentially for not only for the balance of this year, but even into next year, because even with the more acres and a better yield, it just looks like demand for proteins in the world very strong. Big wild card there is what will China do? Look for regional soybean shortages in the U.S. this summer. We're at the end of the pipeline, so what does that mean? There will be imports of soybeans going into ports like Norfolk. There will probably be soybean meal imported in some of those southern states. Will they make it all the way up into the northern plains? That's $1 million question. I know the last time that soybeans were this tight in the U.S., beans made it as far north as about as far as southern Illinois. I don't know if they get all the way up here, but time will tell. Definitely some volatility as we go forward here as far as basis on both soybeans and soybean meal. Soybean oil stocks look to be particularly tight, not something that you hear a lot about. Everybody always says you can only rally the soybean market if soybean meal is a leader. This year, it just feels like we have a situation on vegetable oils in the world and soybean oil in the US that could be very interesting. Keep a close eye on that. Corn stocks will be subject to the safrinha crop in Brazil. Do they get it all planted? What's their weather like? Do they have adequate moisture to get that crop going and beat the window when the heat sets in the dry season? And then, of course, Midwest weather in the US. We can plant more acres, but we have to have the right weather conditions to get a good crop. Chinese hog disease continues. We've seen resurfacing of ASF in China, some PED, some PRRS, small things, but it seems like it's increasing rather than going down as far as the disease issues in China. That's a question mark on demand from China and something that the market's very concerned about right now. Position limits, we talked about that. They went into effect today, up 60 to 80% of normal. The market still potentially has work to do. And finally, I want to leave you with this. This is a slide that we used at a meeting, I think it was probably 4 or 5 years ago. Got a lot of positive comments about that. And it seems like this year has went so fast with COVID and everything, but Easter's just 3 weeks from yesterday. We're halfway through the season of Lent. This is something that I got a lot of positive comments on. Wanted to share it with you again. Easter Sunday is not about Easter bunnies and colored eggs. It's not about the end of the winter or the freshness of spring. It's not about God at work in this world. It's about God at work in this world for you, no matter the circumstance, in spite of COVID. It's about real hope in the midst of hopelessness, real life in the middle of the shadows of death. It's about God's forgiveness in life where there is guilt and sin. That's us. The resurrection of Jesus makes Easter the key to a life worth living. Because when God is at work for you, there's nothing to fear. Not COVID, not bad markets, not what's the weather going to do. Wishing you a happy Easter, and we'll be back after the March grain stocks and planning intentions report. We may wait until the April supply and demand numbers to put it all together, but we'll try and get this information out. I really would appreciate your comments that if you want some changes or if you appreciate these webinars, we'll keep doing them. It's a lot more efficient way than to try and put meetings together and take your time and our time. This way you can look at it when it works for you. The map of our facilities, we are here to provide service and value to you each and every day. Our originating team that you can call with and talk with different marketing options, Hillary, Joel, and John, all on board to help you out with your decisions. Thank you very much for taking time out of your day to participate in this webinar. Please feel free to contact me. And with that, have a great day, have a safe spring, have a blessed Easter.